The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.
And welcome into Your Game Plan for Retirement, where we talk with author of the book Income Allocation, David Gaylor. David, income allocation is a different financial model than the old asset allocation. What do people need to understand about the difference between income allocation and asset allocation?
The first thing they should understand, Peter, is asset allocation as a theory failed. So really, we can't ever trust it again. And what they need to understand about income allocation is covering your basic lifestyle with a contractually guaranteed income to make sure that your lifestyle doesn't change in retirement is critical.
Well, on today's edition of Your Game Plan for Retirement, we will talk about the fundamental differences between income allocation and asset allocation and discuss why having both plans, and specifically having an income allocation plan, has proven to help you stabilize and secure your retirement. And as we always do, we'll introduce you to your local income allocation coach. And David, in Northern PA, for a retirement built to last, we turn to the team from ASC Financial Group, Ralph and Josiah Grauso.
I've known Ralph and Josiah for almost 10 years now, and they've become very, very dear friends to me. I know their family well. We've traveled together. And I want to tell you, the people of northeastern Pennsylvania, the Poconos and Allentown, give them a call at 800-939-8633. Schedule some time to visit with Ralph and Josiah Grauso.
For millions of Americans who retire every year, the task of ensuring that your money is working hard enough to provide you with a consistent paycheck can make the job of working for that paycheck seem easy. Retirement doesn't signal the end of financial worry. In fact, for the majority of retirees, it's just the beginning. The assets you have built must be able to provide you and your family with financial security for all the years to come. That's why you need a game plan for retirement, making sure you have a plan and that your money is working hard to provide you with an income you can depend on. This is Your Game Plan for Retirement.
And welcome back to Your Game Plan for Retirement, the show that challenges some of the traditional financial planning concepts and outdated conventional Wall Street wisdom on how to build for a successful and secure retirement. We talk about the income allocation model that can provide for more financial freedom in retirement through a foundation of predictable streams of income. And we always check in with your local income allocation coach in Allentown and the Poconos. He is Ralph Grauso, president and founder of ASC Financial Group. From the Lehigh Valley down to Allentown through the Poconos, your local resource for the type of information you hear on the program. And Ralph, we always appreciate your time. Thanks for being here on Your Game Plan for Retirement.
It's good to be back with you, Peter.
Well, it's always a pleasure having you on the program, and I thought we would spend a little bit of time today talking about the way that I think the vast majority of people are probably saving for retirement, and that is through their employer-sponsored group plans. Can you talk with us a little bit about these employer-sponsored group retirement savings plans and maybe hit on some of the benefits and disadvantages for us?
Yeah, well, first let me tell you, Peter, that back in the 80s was the advent of the 401k. Up until that point, many companies offered what we call a defined benefit plan, which basically said, you know, I'm the employer. I am going to put money away for you as an employee on an annual basis, whether that be through a defined benefit plan or a profit-sharing plan. And if you stay loyal to the company, you become vested. And then at retirement, we are going to convert that money into a stream of income that is guaranteed for the rest of your life. And many folks retiring during the 60s, 70s, 80s, 90s had these type of plans. But with the advent of the 401k during the decade of the 80s, what happened was a shift from defined benefit plans to these 401k plans, and the 401k plans are totally voluntary. And it was dependent upon the employee to make contributions into that plan. And some employers would match that contribution. And if you're listening today and you have a 401k and you're being matched, that's an excellent, excellent way to accumulate money during your working years. The problem exists is that in many 401ks, Peter, there are limited choices. And what I mean by that is limited investment choices. Typically, the custodian of the 401k, your custodian could be Fidelity, could be T. Rowe Price. These brokerage houses or mutual fund companies will give you just a certain amount of choices of where to put that money. And many, many times the employee has no education on what is the appropriate investment for my risk tolerance. And some of them will just look at returns and say, hey, you know what? This particular fund had the greatest return, so let's put the money there, when in fact they're putting it into a very aggressive fund. Or they may be putting it into a fund that in 2008 lost 40, 50% of value due to that market correction, that market crash. So the second problem becomes education. And unfortunately, 401k administrators are not equipped to educate their employees on proper investment strategies. So that becomes a problem. And they're just not getting the proper advice along the way. And then there's the tax implications of 401k. Understand that a 401k, while you're investing, while the money's growing, it's growing tax deferred, but it's not a tax avoidance. So we have to look at distribution of that 401k plan. And if it's not taken out properly, it could become a tax explosion, not only to the employee, but to the employee's family, should that employee pass away prematurely, or at any point in time that they pass away. Those monies now are going to be a taxable event to the beneficiaries.
Well, you've hit on a number of different topics there dealing with the 401k. Let me take a step back for just a moment. When speaking of the 401k, there are a myriad of other different combinations of letters and numbers in the tax code, whether it's a TSP or a 457 or a 403B, a number of different types of plans, or even just an IRA. Generally speaking, a lot of these plans behave in similar manners at a certain point in time. However, you really need to know the rules of your individual and specific plan in order to know what applies and doesn't apply to you. Ralph, as you mentioned, not a lot of education is given on these type of plans. Can you help somebody better understand their plan and some of those choices and options that you just described?
Yeah, in fact, Peter, what we do when folks come in to see us, we encourage them to bring in their plan documents and their statements so that we can take a better look at how they're positioned and are they taking advantage of the match that they're receiving. I just had a couple that had come in to see me last week, and they work for a very large company in the Poconos, and they are participating in a 401k plan, and they were contributing around 3% of their salary into the plan. However, we pointed out to them that the company would be matching up to 6%. They weren't taking advantage of that full 6%. And they both expressed to me the fact that they could contribute more, but never realized how that match worked. And understand, with a match, that's free money, folks. I mean, if I put in $100 and they match me with $100, there aren't too many places that will do that. So you want to make sure that you understand not only your plan options in terms of investments, but also your matching options and how that work. And then we need to address, should we contribute over and above the match? And that becomes a whole other story, whether that would be appropriate.
Well, when you mentioned the fact, as you gave the history of the 401k plans, that it moved to more of a voluntary participation type of setup, that voluntary participation means you don't necessarily have to participate. So I'm willing to bet there are a lot of people out there that maybe are missing out on some of that match or free money, or are not participating in the 401k plan, which really could be a detriment to their retirement, couldn't it?
Well, sure, because the nice thing about a 401k while I'm working is it's a forced type of savings. They are deducting money from my paycheck before I ever get it. And most of us, regardless of how disciplined we may be, once the money's in our hand, there's always a way to seem to spend it and for it to leave our hands.
Yeah.
So by taking that money out before we receive it, becomes a way of disciplined savings, and over time can make a tremendous difference in the amount of money we accumulate, and also the tax benefit of the fact that we can, in many cases, get a tax deduction for the amount of money that we contribute to that 401k, thereby saving us some taxes along the way.
Now, do you think that necessarily is a good thing, Ralph, that we are delaying paying that tax bill? Because I know that the tax deduction today doesn't forego taxes. It doesn't eliminate taxes. It just pushes it down the road into retirement. And one of my concerns is that tax rates may go up into the future. Might not be a concern for everybody, and this might be another case where each individual's specific set of circumstances is different, but is delaying paying the taxes on that 401k, do you believe that to be a benefit of the 401k, or is that something people need to consider the ramifications of?
I think it's basically they just need to consider it, Peter. Everybody's situation is unique, is different, and I think they have to take a look and say, does taking that tax deduction now make sense? I do agree with you. I believe tax rates are going to be higher in the future, but there are many folks I sit down with that believe that tax rates incredibly may go down and that they're not overly concerned with that. But for those that are concerned with deferring that tax at a higher rate, many of these 401k plans are offering what's called a Roth strategy, whereby you won't get a tax deduction for the amount of money you put in, but your money will accumulate tax-free and then can be distributed tax-free. And so I think for some folks out there, that might be a great option.
Well, tax-free income in retirement, certainly an option to be considered. And checking back in with the author of the book, Income Allocation, David Gaylor. David, when people are saving for retirement and eventually reach retirement, I think a lot of people are pretty excited if they can reach a status where they are debt-free. They've got their home paid off, they've got their vehicles paid off, no credit card bills that are carrying over more than month to month. However, are you finding that a lot of people have yet to pay their tax debt and therefore do have a debt to Uncle Sam? And are they surprised about this? Have they even considered that debt and what it means to their retirement?
No, most of them haven't. They look at the 401k balance and they see, I'll give you a great example. A couple I'm working with right now, $1.2 million. It's all IRA money. The only thing they have is $30,000 in checking and savings. That's not IRA money. So their entire asset base going forward is untaxed money. And it's hard to create a strategy when you only have one type of money to deal with. So inevitably, that's going to cause their Social Security to become taxable in the future if they withdraw enough. And here's what can happen. Up until a certain point, Social Security is tax-free. But after a certain point, 85 cents of every dollar becomes taxable income. And if the IRA is causing that $1 withdrawal from an IRA or 401k is creating $1.85 of taxable income. And then even in a 15% tax bracket, I'm going to lose 28% of that. So the IRA or the 401k is the primary cause of Social Security to become taxable, but it's actually taking a tax-free dollar and making it taxable. So we're getting a double whammy on those withdrawals, and people aren't thinking about this.
Well, again, Ralph Grauso is the local income allocation coach for Northern Pennsylvania, Lehigh Valley, Allentown, and the Poconos. And Ralph, that double taxation and the implications it could have on other sources of income, such as Social Security, seems to make that decision on whether to save tax deferred or we pay the tax now and have tax-free income into the future, seems to make that a very important decision.
It all comes back to analyzing their 401k and what options are available to them. And that's something we do for our clients, for the folks that come in to see us.
Well, folks, if you would like to review and evaluate your options with your 401k plan, the team at ASC Financial Group, a retirement built to last, Ralph Grauso, Josiah Grauso, they can help you review and analyze all of your choices and options. All you have to do is pick up the phone and give them a call at 800-939-8633 when it comes to how much to save in that 401k, how much of the match to capture, whether or not to do that in a tax-deferred, or as Ralph just mentioned, that Roth option for tax-free income in retirement, or how to balance those choices and options within your 401k. These are important decisions for you to make. They're important as far as the implications they will have to you when you do retire. So make sure you're making the most of every dollar that you have the opportunity to save for retirement. Talk to the team at ASC Financial Group, 800-939-8633. That is an option that they provide to the radio listeners, to you, on a complimentary, no-obligation basis as an extension of part of this show. So you are under no obligation. There will be no cost to that review and analysis. All you have to do is call from today's show to 800-939-8633. And Ralph, you mentioned that while some of the 401ks may have limited options, there still is not a whole lot of education when it comes to those options and how much risk may be associated with them. What are the fees with the options I have in my investments? Most of the times I've participated in a 401k, the only guidance I ever got was make sure the lines add up to 100%. So as part of the service that you provide there at ASC Financial Group, can you also help listeners review and evaluate what individual investments within the 401k might be most appropriate for them?
Well, we can do that absolutely by just going through a simple questionnaire that we have designed to look at somebody's risk tolerance and then match that up to what their investments are now from a risk exposure. But you hit on something very important there, administrative costs. You know, there are fees embedded in these 401k plans. And, you know, honestly, there's fees embedded in any type of plan that you have. You don't get something for nothing. But I think you have to understand and evaluate and know what those fees are. And unfortunately, they're not usually very transparent and forthcoming in exactly what is this 401k costing me? What is this mutual fund costing me in the terms of fees and expenses? And why that becomes critical, Peter, is that if I'm paying a 2% fee and I read the prospectus and it says I could achieve an average of 8% a year, well, I need to deduct that 2% off of the 8. So I'm really getting 6%. And then if the account goes down and I get a negative return, do I still pay the fee? Well, of course. So I'm now paying a 2% on top of the loss I took. So I think what our listeners have to understand as it relates to fees in their 401k, that not only does it reduce their gains, but it compounds their losses. So they need to understand what those administrative costs and fees are.
Absolutely excellent point, and I fear that most people do not understand that simply due to the fact that it is not readily available or disclosed to them. That's not information I've ever seen in a 401k enrollment packet or disclosed on any statement, is what the fees of the individual investments are. Folks, if you would like to understand that, it may change your choices when you're making the selection of what investments to be in. Pick up the phone and give a call, because Ralph Grauso and the team at ASC Financial Group, a retirement built to last, they can help you with those choices and options. And again, understanding the fees and the implications of those fees. All you have to do is give them a call at 800-939-8633. Again, that's 800-939-8633. And Ralph, even if I've been working for the same company for maybe 10, 20, 30 years over time, the selection for the investments that I've made at the beginning of my tenure might not still be appropriate for me as I am nearing or getting even closer to retirement. So it's not something that is static and permanent. We need to be adaptive with our choices that we're making inside of our 401k, don't we?
You know, we absolutely do. And we utilize something called the Rule of 100. And, you know, this rule has basically been around for about 60, 70 years. It's a fundamental financial planning principle that's been time-tested. And basically it says, whatever your age is minus 100, the difference, that's the percentage that's acceptable to risk. So if I'm 55 years old, 55% of my money should be in some type of safe or secure account. It's okay to maybe expose 45%. But if I'm 70 years old, 70% of my money should be safe and secure and 30% in risk. And what we normally find with folks, in their 50s, 60s, 70s is they violated that rule. In fact, we find many people where, let's say at 65 safe, 35 risk, they're the exact opposite. And they have 35 safe and 65 risk. And this just, once you violate and deviate from the norm, bad things can certainly happen. So that's kind of the principle we look at in determining a risk tolerance with an individual.
Well, you need to make sure that your investments do match up with your time in life, what is appropriate for you to be risking versus maybe what you need to keep safe and preserved so you know it's going to be there in retirement. And there are some opportunities along the way for you to take greater control. Ralph, a lot of times there's not a lot of choices within the 401k plan to take control. That's another maybe detractor, maybe something that isn't so much of a benefit of the 401k is the fact that we don't have a whole lot of control with what happens to our money as far as outside of the plan, or as compared to outside of the plan, we have much more control. But there are some opportunities for individuals to take more control of their money that is in that 401k and perhaps change the investments or take some of that risk off the table, correct?
Yes. In fact, I had a woman in my office not long ago, a single gal, and she worked in her field, but it was the same field, but worked for different companies. And along the way with each company, she had a 401k plan and left that company. And what happened is her 401k plan became static. Now, what she didn't realize is that when you sever employment, you're allowed to roll that 401k over into an individual retirement plan, thereby taking control of your retirement money. And so it's important for our listeners out there to understand that if you've had a 401k with an old employer, you're no longer working there, you do have the right, regardless of your age, you do have the right to roll that money out of that plan and put it into an IRA where you control the money and you control the investment choices. And we've helped thousands and thousands of folks over the years in the Lehigh Valley and in the Pocono with doing these type of 401k rollovers.
Folks, if you would like to have that type of guidance to make sure that you are doing the correct things with your 401k, whether it be to roll it out or take an in-service distribution or take more control of your money to build toward retirement or reduce some of the risks to your portfolio, or maybe just take better care of that money in investment options that are not available in your 401k, pick up the phone, give the team at ASC Financial Group a call, 800-939-8633. Again, that number, 800-939-8633. A retirement built to last is their motto, and that's what they can help you with in making sure that your 401k does provide you the consistency and the ability to relax and rest assured that it is there for you in retirement. Ralph, do you find that a lot of people have trouble with that, taking a 401k and turning it into retirement? Is that a problem that you help people face with any type of frequency? What to do with the 401k to turn it into retirement?
Peter, there's a commercial that's been airing, and it's basically the theme of the commercial is, what's your number? How much should you have in retirement? And you'll see people walking around holding a number that might say, 800,000 or 400,000 or $1 million too. But, the commercial has missed the point, because it's not a matter of the lump sum that we accumulate. It's a matter of the income that lump sum will provide for us. And unfortunately, 401ks are not designed to provide for income, particularly guaranteed income. And so many people have a tough time transitioning that 401k in retirement to income planning. And that's where we help folks and show them what are the options that they have to take that money and put it into a vehicle that will give them a stream of income, that the predictable income coming in every month. I say this many times, the happiest people I know are folks that are getting guaranteed income, because at the end of the month, they know that another paycheck is coming in. They can spend that money knowing that at the end of the month, another paycheck is coming in. So setting up your 401k, nearing retirement and in retirement to income becomes crucial to a retirement built to last.
Ralph, the choices and options available inside of the 401k versus what most people truly and actually need in retirement and what makes for a satisfied retiree. Does the difference in those type of plans to you illustrate the fundamental difference between an asset allocation model and an income allocation model?
Right, exactly, Peter. And so, the 401k, while it was accumulating, it might be okay to use asset allocation. But once you're in retirement, that asset allocation is not going to work for you. And so the income allocation method, which, by the way, is described very succinctly in a book titled Income Allocation, that would be available to our listeners by just giving us a call, will explain how income allocation is far superior in a volatile market, in a market where 1 week it's up and next week it's down, 1 year it's up and next year it's down, so that we can have predictable income and safety of our money along the way.
Well, folks, if you would like a copy of that book, Income Allocation, all you have to do is pick up the phone and give a call to Ralph Grauso and the team from ASC Financial Group, 800-939-8633. If you'd like to pick up a copy of the book, Income Allocation. Again, that number, 800-939-8633. And Ralph, as we close out the program here, could you quickly for us just recap some of the top benefits that you can help somebody realize for their financial future by coming in for that detailed financial review and evaluation with you and your team?
Certainly, Peter. I'd love to. Number one, risk exposure. How much exposure are you taking? What happens to your portfolio that you have now if we have a reoccurrence of a 2008 scenario? So listeners out there need to know what their risk exposure is. Secondly, what are the costs of your current plan? What are the fees that you're paying? What are penalties, if anything, to leave the plan that you have now? So we need to have an analysis of that. And then finally, putting together a plan that makes sense, that our clients feel comfortable with, that we can put into play, that will provide them with peace of mind and security and knowing that they can sleep at night and that they will have an income that will be there no matter how long they live.
Well, folks, ASC Financial Group, from the Lehigh Valley to the Poconos down to Allentown, a retirement built to last is what they can help you design and build. Ralph Grauso, your local income allocation coach, has made his time available to you on a complimentary, no-obligation basis. If you call from today's program and would like that detailed financial review and evaluation, pick up the phone and give a call, 800-939-8633. Again, that number, 800-939-8633. Or if you'd like to learn more about the income allocation model and what are some of the benefits that it provides to retirees, Ralph has also made available the book. If you call from today's program, he will provide you a copy of that book, Income Allocation. Again, the number to call, 800-939-8633. Time moves by very quickly here on the program, as it does in life. The future gets here before you know it, folks. So make sure you're making the most of today and your financial choices and decisions to make the most of tomorrow. Again, give Ralph Grauso and the team from ASC Financial Group a call, 800-939-8633. Ralph, we always appreciate you being here on Your Game Plan for Retirement. Thank you.
Thank you, Peter. Good to be chatting with you again.
And we'll look forward to chatting with you again next week on Your Game Plan for Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.